if I was to examine an economic threat to some family households, it's the cost of affordability metrics. And I've got a friend who bought a $3 million house on basically a 0% interest rate back in the COVID days. And now selling the house because obviously we're not going back to, those ridiculously low rates during obviously that black swan event of COVID. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, economic risks in 2025. Yes, we have a new year. We've got new concepts to navigate from economics. And of course, we have a new president of the United States, the Big D, who of course is on a bit of a warpath when it comes to economics. So there certainly will be some trickle down effects from his presidency. So we're going to dig into all the ideas around risk and certainly how the property market will fare off the back of that. Ultimately, real estate is really a game of supply and demand, and the safe haven for real estate right now, as discussed in the last podcast, is really a lack of new supply and too much demand. But certainly economics plays a part, and today I want to go through a macro journey of economic risk in 2025. But of course, the drill, regulars. Play the program in double speed, get your life back. And of course, all the episodes are done are lessons on real estate. So if the doom loop of economic risk doesn't sit well with you and you just want to be positive, then don't listen. Don't listen to this one. I give you permission to turn me off. But hey, if you want to explore what could go wrong, let's do it. Certainly when it comes to real estate investment, economics is not a lake, it's a river, and things are always changing. And of course, sometimes that change with economics can lead to all sorts of ways real estate market actually ends up growing. For example, an economic shock like COVID actually made rates very, very low. And of course, in some respects, the real estate market actually performs better when there is economic shocks that occur to the Australian economy. And in some respects, a good old-fashioned downturn can actually lower rates, and because Australia is very much an economy based on housing, it actually favors the property owner, and we saw that during COVID. So economic risks sometimes as well can lead with it to massive opportunity. So I just want to highlight that, because sometimes when we hear word risk, we start to hide under a rock. Certainly don't hide under a rock. There's plenty of opportunities to make money out of real estate. And really, I don't mind the market carrying a little bit of risk, because if everything's too honky-dory, it can make buying properties basically less feasible. So let's go over some of the economic risks when it comes to 2025. Let's talk about what could happen this year. Well, certainly the number one risk which we can go through today starts with Trump, the Big D. Now, it's quite interesting. America and Australia probably won't have a trade war. And the reason being is America basically has a $14 billion trade surplus over Australia, which means that the value of goods and services that the United States exports to Australia is $14 billion more in value than the goods and services Australia exports to the United States. So effectively, we buy more American goods than Americans buy Australian goods. So really, there's no reason to go to war directly with Australia for America when it comes to the balance of goods. America, though, with its neighbors, for example, Canada, which you would imagine would be America's little baby brother, well, Trump's already suggested a 10% tariff to a 25% tariff on Canadian goods because America actually has a deficit and sells, basically a $7 billion deficit to Canada, meaning Canadians basically sell more goods to Americans than Americans sell goods to Canadians. And of course, the big one for Trump is China. And at the moment, the trade deficit between the United States and China is indeed significant. It's around $27 billion in China's favor. So Trump wants to do something about that. And of course, his argument is he can change the way trade works by imposing a tariff and slowing down basically the deficit between the countries and also propping up local industries. And of course, Australia actually has a trade surplus with its biggest trading partner, which is China. And so it's a little bit complicated because Trump is basically buying more Chinese goods than selling American goods, which is not necessarily good for American companies. And China is buying more Australian goods than Australia is buying Chinese goods, which is great for Australia's economy. And so there could be a shift in this narrative because obviously if tariffs occur, there's going to be an increased cost to import goods into America from China. And that will mean that companies have to charge more for those Chinese goods inside of America. And in many cases, those businesses will have to pass on that extra cost for the Chinese good or Canadian good or Mexican good or European Union good. And of course, this can create supply chain disruption whereby all of a sudden a good is not even worth buying. You might as well buy the local good instead. And it can reduce, obviously, the amount of competition, which does happen. And we saw this in Australia with the Holden car. If you can remember, back a few moons ago, we used to make our own cars in Australia. And we used to have a production plant in Adelaide, and we would make Holdens, the great Aussie car. And of course, Holden's basically had an advantage over the rest of the market because the government would protect the local car industry by putting tariffs on imported cars. In other words, you would pay more for an imported car than you would for a local car. But really what it actually did was, in some respects, create a lack of innovation in our local car company because it wasn't competing at a really fair level. It was getting propped up. And the Holden car missed the boat. It didn't jump aboard electric. It didn't create smaller cars. It went down the total opposite to the rest of the world. And by its end year, it was still pumping out basically fuel guzzlers, giant cars, which nobody really wanted because of affordability, because of climate issues. And so having a protectionist mechanism on your goods can quite often lead to a lack of innovation. The other thing is the Holden car was kind of able to artificially put its price up, which because of the cost of an import car. So if an import car was $75,000 and really the Holden car should have been $45,000, it could price itself at $60,000 because it still was the least expensive car on the market in context. So there is a cost push inflation effect on tariffs, and obviously that can happen at a local level where you push up your prices because overseas imports are way more expensive, or conversely, if you are buying those overseas exports, there is a cost push on that as well. So it's interesting because obviously Australia's biggest trading partner is going to have a change in the balance of what goods and services are sold into the biggest economy in the world, which is America. And obviously, if there was to be a Chinese good economic slowdown, there are some pros and cons to some of it. For example, those cheaper Chinese goods could find their way to Australia, which doesn't create a tariff on the goods. And because there's excess goods coming out of China, which are not being absorbed in the United States, then obviously we might be able to buy less expensive Chinese goods, which of course is just deflationary on that particular item, which could help obviously people's back pocket. But equally, the reduced production may actually have a slowing effect on China, and a slowing effect will have, again, a ripple effect into Australia, which we'll discuss. So the first real economic risk or threat is basically Trump. And he's going to make America great again, and he's going to make the world pay for that. So Americans are on board with that. And I guess here in Australia, we'll just have to wait and see where things end up. Sometimes with this stuff, there's more rhetoric than actual bite, but certainly when it comes to China, there seems to be a battle looming. And really, the China hangover is here. It's not something that is on its way. We're dealing with it right now. And Australia had a trade war with China recently because Australia basically said, could we find out how COVID was started? And the authoritarian government in China simply went, right, you are not towing the line, we will start a trade war with you. And of course, they dropped imports and created tariffs on Australian wine. And so this kind of stuff goes on a bit behind the scenes. But really, Australia over the last 20 years structurally has grown a lot off the back of China. And the growth rates in China have been astronomical, certainly through the 2000s and into the 2010s. You had double-digit GDP growth rates coming out of China, which, again, was great for Australia because we export more to China than import. So we make money out of China. And so we are always left with a trade surplus from doing business with China. So China's hangover is here. It's slowing economic growth. China is not growing as fast as it used to. It's got an aging population. It's got debt problems. It's had to create a lot of stimuluses to fix its property market, which is oversupplied. The political authoritarian government is becoming even more increasingly authoritarian, trying to consolidate sort of power. And really, quite often we say that, I guess threats economically can lead to threats in wars. And so money wars, trade wars, real wars is really the way to understand it. And really China, if you like, is had a money war with the United States for a while because of the way they run their currency as well, where it is not seen as really floating against the US dollar. It's artificially propped up, which again, for the balance of power or the balance of goods and services flowing, it's a little bit uneven. And a trade war obviously can solve that problem, which can lead eventually to a real war. And of course, no one would like to see two superpowers boxing it out. Obviously, we're already dealing with another superpower right now, Russia, boxing it out with Europe. So these kind of geopolitical issues are very real. And there's a lot of geopolitical aggression coming out of China to the point where now it knows that if it can't hold monetary manipulation over you, it will grow as a threat through its military. So geopolitical aggression, aging population, really a geopolitical authoritarian government. One could argue even a fascist government these days. And obviously there are some big environmental challenges in China, struggling with degradation of their soil to grow food. They're becoming resource deplete, and really it's undermining their long-term development. And if all of that sounds ugly, well, of course, China is the largest populous country in the world today, but within 5 years, it won't be. It's actually shrinking, and it's going to be overtaken by India. So, of course, Australia has just set a free trade agreement with India, which is a very smart thing to do because India is overtaking China as the biggest country in the world. But all of this leads to certainly a weaker growth rate for China, but as well, global growth is going to be, slower. It's not dire, but it's certainly going to be slower. So Vanguard, which is one of the biggest companies in the world, probably owns everything, has some growth rates, as does the IMF, global growth predictions for global major economies. Vanguard has the GDP of the United States growing at 2.1%. IMF has it at 2.1 as well. The Euro area, IMF has basically not growing at 0.5%. Vanguard also has it at 0.5%. When it comes to China, both have it at 4.5%, which is considered a lower growth rate for China. And Japan, both the IMF and Vanguard have it at 1.2% growth, which is another big economy, the third biggest in the world. So Europe's definitely not going to grow. The United States is going to have some reasonable growth. And then Australia, actually, according to the IMF, will grow at a GDP rate of 2% and or 2.5% from Vanguard. So Australia will grow. It's certainly doing better than Europe, that's for sure. And obviously the zombie economy of Japan, where effectively the Japanese Reserve Bank needs to continue to buy its debt, is always a low-growing economy these days. But as you can see, there's no runaway growth marketplace. There's no 10, 20% growth market like the old days with China, where it was like posting GDP growth of 14% for the year. And of course, that would fuel a lot of surplus for Australia. And so if we look at the unemployment rates around the world, probably the biggest one is going to be in China and the euro. China sits at 5.1% according to Vanguard in 2025. The euro basically 6.9, call it 7%, which is big. Australia a little bit luckier than the rest of the world, with a unemployment rate of 4 to 4.5%. And obviously, the closer we get to 4.5% unemployment, the case is higher for a rate drop. So if we were to look at the cash rate around the world, euro is going to be quite low at 2 to 2.5%, probably representing just how lack of growth is going to unfold there. China will sit at monetary policy a little bit at a stimulus level. Japan basically won't have a cash rate, and Australia's cash rate should balance out at circa about 3.5%, according to Vanguard. So that's the growth of the world. And obviously the Australian economy is slowing after growing quite handsomely through the last decade. Inflation has peaked, but obviously still remains a little bit of a concern, and we might talk about that as well. But Australia's got to get through a 6 to 9 month period before potentially rate drops happen, and may suddenly feel the pain of that delayed interest rate drop. And again, if I was to examine an economic threat to some family households, it's the cost of affordability metrics. And I've got a friend who bought a $3 million house on basically a 0% interest rate back in the COVID days. And now selling the house because obviously we're not going back to, those ridiculously low rates during obviously that black swan event of COVID. And even a cash rate of 3.5% does not work for her economic household. So there's some real situations unfolding where inventory will come onto the marketplace and create what I would view to be a more balanced market. The longer rates stay up, the more households will hurt, and particularly households that have bought and have high amounts of debt and perhaps, haven't been paying off their properties for 15 years. For people who've been paying off their properties or owned real estate for 10 years, really the rates are less impactful. It's more people who bought over the last 24, 36 months, which haven't been able to eliminate debt and haven't been able to save and are just stuck in this, probably got a very cheap interest rate and bought a property. And so a bit of that stock will come back onto market. Fortunately for a lot of those people, they're up in value on real estate. So they'll buy, something else, something more affordable. And really in 2025, you may see a trickle down to affordability metric. I know for that particular friend of mine, she's swapping a $3 million house for a $1.8 million house, which is more in her long-term cash rate ability to service that loan. So even though she's a seller, she's also a buyer, which again absorbs the stock that comes and goes off the marketplace. But certainly Australia in 2025 may just start to feel the pain if rate cuts don't come through and start to happen. Now, many people believe you've got to wait it out till maybe July 2025 and you'll start to see anywhere from 3 rate cuts to 5 rate cuts, depending on which bank and economist you listen to. But the end of 2025, the CBA has suggested a cash rate of 3.1, Westpac 3.35, NAB 3.1, and ANZ 3.6. And Vanguard, of course, the world's biggest company, has it at more like 3.5. So it really depends on a couple of variables, and certainly inflation is one of them. But if we get the cash rate down to circa 3.5, means you should be able to have a home loan at about 5.5 or just under 6, which is better than where we are. But certainly I'm not sure if it'll get much lower than that. So that's a risk. What other threats are looming? Well, probably one of the biggest challenges, certainly in 2025, is slow productivity. Jim Chalmers quoted, "There is no more important structural problem in our economy than productivity, no higher priority to reform." It's from the big dog himself, Jimmy, old Jimmy. And slow productivity is a measurement of how you grow an economy. You can really grow an economy in 4 ways. You can add more people, which Australia does. We know they do that. Bring them here, sell them houses, start coffee shops, create jobs, bring in consumer demand. It's basically a model of economic growth. You can basically increase your productivity, be more efficient, do things better, faster, quicker, and be more productive in workplaces. You can sell your resources, which again, we've talked about could be a bit of a threat, or we will talk about could be a bit of a threat based on the China hangover, and you can innovate. The problem for Australia is we don't spend enough money on innovation, so we don't really come up with too many ideas. There's no sort of, obviously OpenAI just came out and has revolutionized society. It's not an Australian thing, it's an American thing. So we probably can strike that off the list when it comes to productivity, or growing our economy rather. People and productivity and resources are really the 3-way Australia grows. So we're going to have a little bit of a talk about those 3 because they're pretty much key to the system keep growing. And obviously we need growth because growth then links to how we all live. So there is a paradox of productivity occurring. You've got OpenAI making things more productive. You've got a lot of millennials having babies and they can't even go to work because a large proportion of Australians are basically can only work part-time. So that doesn't make the world too productive. You've got rising costs of labor, which means that companies ultimately are not making enough to retain earnings to re-spend on growing their companies. And of course, you've got an aging population, which as well, means that there's certain skills mismatches and education gaps in the workers inside of Australia. Basically, we don't have the skilled worker to match what Australia needs. There's a disconnect between what has been taught and what is needed and what skills people have. And really, in the real estate market, there is no real estate because there is really a skills gap on how many people can build real estate in Australia. We've never really increased our build volume, though we've increased our population base. So slow productivity, we have a skills problem. We have low innovation through R&D. We have a lot of regulatory burdens. Government is becoming a beast to itself in this country. There's a lot of layers of government and there's a lot of complexities with regulations. New regulations to basically reduce business efficiency. And you might take stock of Donald Trump actually noting this in the United States and putting effectively Elon Musk, who obviously is an engineer and can see where there's things that don't work, in charge of government red tape. So it'd be really interesting what happens over there when it comes to removing regulatory burdens that hold companies down. And to the point where here in Australia, there really is no real financial planners left. They're like the panda bear. A financial planner is a panda bear. And you can imagine, like, all of a sudden there's productivity in people's wealth they created over the years, but they don't know how to spend that productivity because really there's no financial planners to guide them on what to do. So people just grow old and die with a ton of money stuck in housing. And again, it's just not productive. So Australia's got all these regulatory burdens. We don't have a solution for it. And obviously we've got infrastructure deficiencies, gaps in transport, digital infrastructure. All of this hinder the ability for the movement of goods and services. And Australia's a massive landmass, but struggles with its infrastructure. It's just never able to be infrastructure rich, no high-speed rail to move business people around, for people to live in regional cities that are further than 125 kilometres, etc. And of course, obviously, when it comes to supply chain metrics, we are connected to a global world, which again, there's a lot of moving parts to that. And we really don't have our own supply chain sorted. And it's something that, again, kills productivity, because when there's a bullwhip effect in other economies, we pay the price for it. We can't produce our own stuff. So we have to be exposed to inflationary measures of the globe. And again, that in itself affects productivity. We've got limited competition in some sectors. You know, for example, the food sector, we've got Coles and Woolworths and Aldi, right? And really Aldi, you know, kind of doesn't really provide enough food choices. It's kind of like if you want to get a giant, I don't know, tin of red beans, you can go to Aldi. But for the most part, for fresh food and produce, you know, we've only got two suppliers. We've got basically airlines which send other airlines broke because there's just this inability for competition to occur. You know, Qantas and Virgin dominate with Jetstar, which is a subsidiary of Qantas. And so you don't have five airlines, so things don't get cheaper. And again, there's that sort of, here in Australia, we've got four big banks. Again, like they own pretty much all the other banks. So it creates a lack of innovation, of new business and new productivity into the system. And of course, the biggest challenge is aging population. You know, we've got a shrinking working age population, leading to a lower workforce participation and overall productivity. And of course, the housing market is distorted. High cost high housing costs really do mean people struggle to be productive. And what I mean by that is if you look at really the priority and performance of where someone really wants to live, and a lot of that is close to or within a commutable distance to where they work, we basically 75% of people can live close to where they work, but 25% of people can't. And again, for that workforce, 25% of your workforce being unable to find an affordable property too close by to where they work creates a productivity issue. You know, they're not capable of working to their full capacity, which of course is the dogma of the structural problem of productivity. So Australia recognizes it's got great resources, even if China doesn't necessarily need as much as they have done in the past. We can probably, shuffle the deck and find other trading partners, but that will take some work. Obviously, from a population point of view, it doesn't feel like it has a problem because Australia is a bit of a draw card. Let's face it, people want to live here. I have a lot of local friends who come from other countries around the world, perfectly good countries, Italy and Germany and stuff, and they all seem to love Australia. And I say, well, why don't you just go back to Europe? And really the opportunity, they see opportunity. They see Australia as a land of opportunity. Even though really from a cost of living point of view, they struggle, which is quite sort of mind-blowing in a way. So obviously, let's talk about iron ore. And Australia's iron ore is a significant player for the national economy. Why we make more money out of China than they make out of us is we sell them iron ore. Obviously, iron ore has fallen off a cliff with what it was trading at. It did get to a pretty high level, though, to be fair. And now the spot price of iron ore in US dollars is below 100. And of course, the economic impact or the risk is iron ore is one of Australia's top exports, and a decrease in the price can lead to obviously lower revenue for the country, which impacts basically budgets, how much a country can spend. And of course, when that you impact a budget, all of a sudden you have less money to spend on things like infrastructure. And of course, if less iron ore is produced, then your tax revenue base starts to be less as well. And of course, lower iron ore can often lead to a weak Australian dollar, which if you aren't sort of trading enough and your iron ore is your major export, the price drop signals a decline in export earnings to the market, which can weaken the currency. And of course, this makes imports more expensive, contributing to effectively inflation. So it's a bit of an issue when it comes to, if you go back to how your economy grows. And again, Australia needs to find other export partners and get over the Chinese hangover. And of course, sometimes it means that the same tonnage of iron ore is bought, but it's just bought at a lower price. So the same amount of work's there, but you're doing the same amount of work, but you're getting paid less for it, which of course is not productive. It does not create productivity. And so just one of those things we've got to deal with here in Australia. We're a land of rocks and minerals. But it is also a blessing that we have that. I mean, so many people come from countries where there's no natural resources and they're very, very poor. Australia will always be rich by virtue of its natural resources. They're always going to be needed. There's just going to be ups and downs within that space. And obviously, if we have a weaker dollar, higher US dollar, we got Trump doing his thing, where could actually balance out inflation with obviously a fall in our export partner, which is basically would lower rates here in Australia if China's weaker. But if tariffs are higher, that kind of brings rates back up. So you kind of meet in the middle, which is where we're at. And obviously for the Reserve Bank is the risk that they've been talking about for 2 years, which inflation pops back out and it makes it harder to lower rates. And of course, if we look at the most recent data, annualized inflation is back on track, which is good, 2.1%. But we've still seen housing inflation grow. Things like rents go up 6 and 7%, which whilst inflation does seem to be back in its bottle, the Reserve Bank of Australia will be watching it, specifically with housing, because again, like if you lower rates and the real estate market starts to grow exponentially again, it may just mean you have to put rates back up. And so they're pretty well balancing what the future kind of looks like. So their big threat, and again, is obviously theoretical if inflation pops back out. For the moment, it seems like it's under control. Obviously, the next threat is spending. You know, we are a services-based economy. We got to spend. We got to give our money to someone else who then gives that money to someone else. The money's got to circulate. And if it's not spending, someone's not winning, basically. So maybe we all just need to start spending. But of course, it's hard to spend if you're struggling to keep up with affordability. So consumer sentiment drops. And obviously, when sentiment drops, less people feel comfortable and safe, basically spending. So consumer sentiment as an index is if the baseline is 100, you want your 100 is like consumer sentiment is high or consumer sentiment is low. The base level is 100. We're at around 95. So we're just below where people feel good. We're not too far below. We have been lower when it comes to consumer sentiment. That is for sure. Back in 2018, consumer sentiment was 75. So how long it remains low for is really the question. And again, if consumer sentiment can buffer around that sort of neither high nor low, we will go into really that moderate cash rate environment where it's not high, but it's not low. It's a great way to understand it. And of course, you can grow your economy through population. And it's interesting to understand population. I think it's the one thing that the Australian government has up their sleeve that they won't let go. Obviously, there are political narratives around just killing off population growth to balance out affordability and bring with it cheaper housing. If you don't have if you don't have population growth, obviously you're not going to have as much property growth in the marketplace. So it is a threat, a political threat, but I think when you think about the other problems Australia is dealing with its resources and its productivity issues and its lack of innovation, the one positive Australia has is you can bring more people here and stimulate your economy because you basically bring 500,000 people here. Now, I mentioned this last podcast. We grew by 500,000 people the size of Canberra last year. So if we do that again in 2025, we will avoid any lower than expected GDP figures or GDP going backwards. So population growth is now occurring from overseas migrants. It's not occurring through natural births. Pre-COVID, you basically had 40% babies, 60% overseas migration. Post-COVID, it's more like 17% babies and 83% net overseas migration. So the world is running in some respects running out of people, and advanced economies are basically having population wars. We want the population. And so, you can move to Italy and get paid 30,000 euros to basically live in Italy, in Tuscany. You can pay no income tax if you have 4 children in the country of Hungary. There's all sorts of ways that countries are starting to deal with the brain gain of high-skilled population people. Portugal, you can be a digital nomad and get a visa and live in Portugal. It's a way the Portuguese can bring basically digital intelligence into their marketplace. You can get a golden visa. So there's all sorts of things that are afoot around the world, but certainly Australia does pretty well just by virtue of our standard of living. It's really a safe place. People see it as a very, very safe place. There's not maniacs running down the street, blowing up buildings, shooting each other. There's no, it's a very multicultural country. There's not this sort of, in general, race tension that you can get in European countries. And so, and it's Anglo, which is the world's language, which is something which is kind of, for a local Australian, kind of like, oh, is it? But for the world, English is really how business is done. And so if you can learn English, if you can bring your children up to learn English, you've in some respects got an advantage over a non-English speaker, because the world language is actually English. But from a global perspective, the world's fast population growth rate is slowing. And by way of example, we went from a global population of 7 billion people to 8 billion people in 11 years. From 2011 to 2022, we grew by 1 billion people in 11 years. To go from 8 billion people to 9 billion people, that won't happen till 2037. It will take 15 years. And then to go from 9 billion people to 10 billion people, it will basically occur from 2037 to 2058. It will take 20 years. So you can see aging population, less fertility, slower growth rate of the world as it stands. And so Australia, because it also has a low fertility rate, needs to import people. And really the annual migration rate now is more than 2 times what it was, for example, back in 2019. What that does, though, it puts pressure on housing and infrastructure to match the population base. And of course, the big problem is supply. There is just no supply. And so the threat, of course, when there's no supply coming through the system, is higher property prices. Eventually, something has to give. And really, if we have an affordability crisis now, what does that actually look like in 5 years when there's still not the amount of stock being produced? And I mentioned this in the last podcast. There was a plan to build 1.5 million homes in well-located areas. If we just look at New South Wales annual building approvals and completions, that has not gone up. It has actually gone down significantly by about 25%. So we're going backwards when it comes to housing our populace. And of course, at some point, there's a bullwhip effect on that. It won't happen in 2025, but it may just mean in 2027, 2028, there is going to be, again, more challenges for the economy with higher rates of capital growth, which is good for real estate investors, by the way, but less good for the economy itself, which struggles to be productive because their association with housing, which is kind of a measurement of productivity. So 2025, what are the 9 economic risks that could happen? Trump and the trade war and the money war and potentially even a real war. We've got a few of them happening. Australia might suddenly start feeling the pain of those delayed interest rate cuts. Slow productivity, iron ore nosediving, inflation popping back out of its genie bottle, consumer sentiment remaining low, weaker global growth, the China hangover, and really, if someone was to meddle with the population growth figures, you may see a threat to the Australian economy. Probably the saving grace is population growth. And so let's see what happens from that point. But there's certainly many positive things as well. I know I'm speaking doom and gloom. I don't want you to walk away from this podcast feeling like it's all over. But certainly the pros, supply falling further. Obviously, the government and banks are highly invested in real estate. We've got fairly low national listings still. If you look at the national listings data, it's way lower than it was previously, and that really does pertain to stock levels, albeit some people are having to maneuver out of their interest rate and basically get a wake-up call into what they're actually worth. Pros is definitely short-term and long-term migration. Lending, it's still pretty easy to get a loan. Markets are pretty fluid. A lot of people have wealth in property. Shouldn't be underestimated. Like the amount of equity Australians have is kind of mind-boggling, particularly to other people from other countries. They're like, wow, how rich are you guys? So we are rich. Certainly people who own assets are rich in this country. If you do not own assets, you're falling behind. Obviously, the biggest winner of them all is the wealth transformation. We've got an aging population with a lot of money transferring their money down the food chain to their ancestors. That's not to be underestimated, a $6.1 trillion wealth transformation. We've got the Olympic Games, which is again going to put much of Australia on the map, from Brisbane to Sydney to Melbourne. We're all going to win off the back of that. And really, there is still a massive dream to live the Australian dream and own real estate, albeit it is fading for some who are not taking action and buying assets. So we will see also in 2025 rate drops. These are all the pros. But behind the scenes, there's economic risks. There's always economic risks. If I was doing this podcast in 2020, there was an economic risk. It was called COVID. If I was doing it in 2012, there was economic risks. There was the end of the mining boom. If I was doing the podcast in 2008, there was economic risks. There was the GFC. If I was doing the podcast in 2010, there was an economic risk. There was the Brisbane flood. So there's always risks. And the reality is the same wind blows on us all. And the reality is you just got to keep moving through it. You can't stop. You can't stay still. Economics is not a lake, it's a river. So keep moving down the river. All right, folks, thanks for tuning in. I'll catch you on the next show as we talk more real estate. Thanks for tuning in to the Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. I would love it if you could give the show a rating and share it with your friends and family.
In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of The Urban Property Investor, take care and bye for now.